Anyway, I'm going to start, as usual, with a summary of kind of what I saw happening in the stock market this week. So we'll start with sharing kind of the chart that we look at. This is a chart. We started looking at this probably in the first quarter of 2022. We've been watching this thing develop and had this up for quite some time. And essentially, it's turned into one big lumpy U at this point, because we're almost back. That point at the very beginning there was the all-time high, which was the closing high was on the 3rd of January of 2022. And so we're almost there again, finally. It's been quite the ride to get there. Let me back it up a little bit so we can see a little bit more time here. So this is back to 2018-ish time frame. And obviously, we had the big pandemic that happened. We had a very strong run up coming up out of that. So it's the fastest 35% down in the history of stock market, but we had a very nearly vertical run after that.
Yeah, those 2 years were pretty amazing.
It really was, and pretty unprecedented in a lot of ways. Not completely unprecedented, but unusual at least. And it really had to do with how much money was being pushed out to try to save the economies of the world, really, from imploding during a pandemic when things were shut down and countries were shut down, airlines were shut down, etc. And we ended up, having a nice recovery out of that, at least for the stock market, but probably put out too much money in the end. Hard to tell.
Yeah, it's hard to tell when you're doing it,
Yeah.
but in hindsight, we may have put out a bit too much.
Yeah, because the top there, which was this January 3rd of last year, was all about inflation at that point in time, which was really starting to pick up. And the Federal Reserve is getting more and more aggressive about their conversations. And so, of course, then we end up with this downturn, because when you raise rates from basically 0 to about 5.5% in a fairly short period of time, you would normally have actually a much bigger downturn. I think one of the reasons that this market has come back and only fell 28% from high to low had a lot to do with just the fact that there is a pandemic here that makes it different.
Yeah.
And I've said this before, there's a couple things that make this different. The fact that there's a pandemic and there's pent-up demand, money coming out. Secondly is 2008, we kind of discovered that we can do, stimulus programs and different
we can
types.
keep the economy afloat.
Yeah, it'll be interesting to see if we can do that forever, because it takes a lot of dollars to do that. But that has helped even this year. As we're going to talk about this year, we had the Silicon Valley Bank, closure, First Republic, Signature Bank, et cetera. All these regional banks were really starting to struggle, and money came out of the government and kind of supported those banks and those programs in lots of different ways, but it worked, and we actually ended up with a nice upturn. So again, 2008, we didn't do that. We let Lehman Brothers fail, and we had a 30% additional drop after that, down to a total of negative 57% from high to low. And so that's different. We're doing that now. So we have to factor that in as far as that goes. So now we get to kind of what's been happening more recently here. You can see this run-up that's happened. It's unbelievable. And October 27th of this year was the low point here out of that downturn. That was a 10% downturn, right? And actually, I got a question this week from one of my clients. How did you know to stay in? Because it looked kind of bad, right? I mean, all those highs are lower. It looks like the trend is changing. The last part of October there was really falling hard the last couple of weeks. And there's a couple things that are important to understand. There's a seasonality that happens. September and October, generally not the greatest months. The mutual funds that are out there have to capture their losses if they want to report them by the October 31st. So that's one of the things that goes on. These guys are selling those pieces. Oftentimes they're going to come back in and buy. And so, we did get a big jump right after that deadline. But one of the key things for us that's really important, and I think an educational point about investing, is you want to stay with the major trend until that trend has turned to the other direction.
Yeah, and there's going to be many 10% downturns and rebounds in your investing career. So, if you get out too soon, you miss out on a lot of the run.
Yeah, because the beginning of that run was monstrous. If you weren't already in the market on the 27th of October, even if it took you a couple of days to get back in, you probably missed out on 5%, run in that short period of time. And unfortunately, that's kind of how it works. And so primary direction, and this is, everybody's got a different idea on how to do that. We look at more long-term things. My favorite area is really looking at kind of some pieces from Charles Dow, right? Charles Dow was the Dow Industrial Average was created by him. He was the journalist who started the Wall Street Journal. This is in the 1880s, and what have you. And he has some pieces that I think are really basic and I really like, and they still seem to work pretty well. So this is my piece,
Your
which
version
is,
of it.
yeah, and I add one piece from him and that I think is important. So the yellow line there is the 50-day moving average. So it's the average of the 50 previous days, each point on that. And then the blue line is the 200-day moving average. Mm-hmm. So for me, primary direction is upward when that yellow line is above the blue line, which happened back in February of this year, right? So that didn't stop. You can see it got closer by the end of October there when it was down, but it didn't cross, right? They call it the death cross for a reason. Didn't happen. You can see it's turned around. The other thing that kind of a secondary piece for me that's really important is the direction of the 200-day moving average. So when the 200-day moving average is up, which it never stopped being up in this particular last downturn, that's an important point for me. So those are two pieces. And then if you look at kind of part of what Dow talked about, he talked about a trend being, if you're looking at an uptrend, you're looking at the lows. Mm-hmm. If you're looking at a downtrend, you're looking at the highs. And so are the lows higher each time? And they were. And that was my main thing in that downturn in October. That low still had a long ways to go before it was going to get below the previous low, because there was a pretty big run up. And so sometimes when you get a really big run up, that was at least partly fueled by the AI frenzy that was happening, what have you. Sometimes when you get that big run up, you're going to get a bigger downturn. So if hey, yeah, it's down 10%, but it was up that much before that. So I mean, one of the things, if you look at the Great Depression, is kind of interesting in terms of the stock market. It was down 87%, but if you look at that chart, it went straight up before that. So it was just kind of taking back at least a portion of that, was just that overabundance of run up,
the overvaluation of the stocks.
Yeah, and you can make that argument here about what happened during the pandemic. I think that's just too much run. It's very steep, and so again, unwinding some of that, and then we get back to somewhat normal. We're still unwinding the pandemic, I guess, is the main thing. So anyway, to answer that question, that's why we stayed in. It's why we used our rotational strategy, and why we've done very, very well in this upturn as far as that goes too. And one of the interesting things as a whole here is that the bond market is also participating here quite nicely.
It's been on a pretty major run lately.
It really has been. And so we have some slides coming up later in the show for a question that was answered. We'll talk about that too. But okay, so here's something from the Bank of America's Global Research Department, and this is kind of interesting. And a lot of you probably don't know about this, but there's an organization called Investors Business Daily. They put out, used to be actually a paper way back when, and they have a thing called a cup and a handle. And I know that a lot of you might not have heard of this, but this is quite popular, and it has meaning because if a lot of people believe in it and it executes, and you get a buy signal, a whole bunch of people are going to be jumping in and kind of making a self-fulfilling scenario. So what they're showing here is that same chart I just basically showed, a little bit longer term, but the S&P 500, the big cup is the downturn, that happened 2008, hit that low 2022, hit that low of October. And then the handle was the downturn we just had, right? And so what they're saying here is if you break above the top of that handle, which was right around 4,600-ish, and we're at 4,700 now, because this chart actually came out on Monday, and we're quite a bit above this as we speak. So we did it. We substantially broke out. And so their projection is on this type of move that we should, on a moderate basis, be in the 5,200 range, on a more aggressive basis, 5,600 range. And again, we're at around 4,700 right now. So This is just the things that are out there. This is what's happening. We talked about the Zweig breadth thrust indicator that has 18 buy signals, all 100% accurate over a 12-month period, at least historically. Average rate of return is 23% in the next 12 months. You have a big month like November, you get that type of return. The average rate of return in the next 12 months is 14.9%. There's a lot of things because people are asking me what's going to happen in 2024. Well, if you look at kind of the averages for what happens when you stop raising rates, that's up, right, on average. When you have these big months, when you get this, breadth indicator that moves, cup and handle now is saying, hey, we're going to go to 52 to 5,600. These are things that are piling up on the positive side. Doesn't mean it's going to happen, but what it does mean is to be a good investor, you have to understand the positive and the negative. And that's the whole meaning of this show to a large degree, is that the negative is super easy to find. It's everywhere. It's lots of clicks, right? And gets people excited and gets them worried. And I get these emails from people, oh, this is going to happen, that's going to happen. What do you think of this? And they're not sending me this stuff. They're not sending me, so that's why we're doing this.
Yeah, and it's not going to be a perfectly smooth upper road. It'll be a little bit bumpy along the way, but the projection a long-term positive gain.
Yeah, it has been surprisingly smooth so far for this little run, which is I need to spend just a few seconds on that because it's a really big deal. I mean, this is something that doesn't happen very often where it kind of goes straight up. Going straight down like we saw in the pandemic, because fear is a very strong emotion.
It happens quite often.
Yeah, it's easy to do. Going straight up, much less frequent. It really is. It's kind of fun. Doesn't mean it'll hold, but it's still fun. I still think you got to have some fun when it's having a good time, and we should enjoy that. And so the Fed met this week, right? Came out on Wednesday. Chairman Powell did something I think quite surprising, and the market responded to it very positively. He kind of doubled down on the possibility of rate decreases next year.
Yeah.
And it's caught people by surprise because even though they've had this dot plot out, we'll describe what this is in a minute. They put this out 4 times a year that is showing that the average board governor thinks that rates are going to be lower next year. They really wouldn't acknowledge it. Higher for longer, higher for longer. And what they were trying to do is, talk the markets into doing some of the work for them. Have the bond market yields go up, which makes tighter money, right? Have the stock market come down, which makes people feel like they're poorer, and that creates tighter money. They've been working on that since November of 21, and all of a sudden they're looking at it the other way and starting to talk about rate decreases. So my own little pet theory, I mentioned this in the daily videos, but I'll talk about it here, is just that I think they're seeing enough softness in the economy upcoming that they feel that they want the market to do some of the work for them here by releasing some of the liquidity. So you start talking positively, bond yields dropped. I mean, the 10-year yield went below 4%. It was above 5%.
Yeah, it was a quick drop too.
Yes, and so that makes monetary easing for the economy. The stock market obviously is up, 10, 11% from that low back in October. And again, that makes money flow too. So that's just my thought process, that they want to have the markets kind of pre-set this up so that they don't have to lower rates as quickly because things will be supported. Now, the problem, of course, is that there's a danger here because we're not truly out of this inflationary environment that we're in. The trend is the right direction, but that's my thought process. I don't disagree with what they're doing because honestly, the one thing that's the biggest danger here is that the Federal Reserve does either raise rates too much or keep them up too long, and then something falls apart that doesn't get fixed and can't be fixed by government subsidies or what have you, and that's where you end up with that kind of hard landing. Okay, so this dot plot, the blue dots are from the September meeting. So again, this comes out every 4 times a year. The purple dots are from the meeting that just happened in December. So obviously in 2023, every single board governor had the same dot because this was the last meeting. They knew where it was going to be. They have a range, 5.25 to 5.5. So
it's in that little in between.
Yep, that's exactly where that is. Now, if you look at 2024, you can see the purple and the blue are both lower than where we are now for the majority of the dots. There's a couple of dots in the blue there from September where they thought it would go higher, but they gave up and they all moved down. And so the average consensus, if you look at those dots, is a 3/4 point cut.
Yeah.
All right. Now, if you go to the CME Fed Market Watch tool, which is the gauge for futures market on where the Fed Reserve will be, they're expecting a rate cut in May and a total of 1.25 rate cuts, in for the year for 2024. So we'll see. Some differential there between what the market's expecting. The Fed seems to be saying, no, we won't be doing it that early and we won't be doing it that much. That's kind of where it's at. But they're not that far off. I don't think it's going to cause huge problems. If you follow that forward, they're thinking in 25 it'll be even lower. 26 it'll even be even lower, right? Does that long term it'll be even lower? Right around 2.5%. For the Fed funds rate, right?
Yeah, and there's also assumption that inflation will be similarly low too.
Yes.
So you don't need a high inflation.
Yeah, and I'm sure the group that was in charge of the inflationary environment in the 70s thought the same thing because they had it under control. They started to lower rates, and then inflation got out of control. And so this is something that's going to be an impact on this particular regime because they know this and they've talked about it. Chairman Powell has brought this up. They're afraid of being that group that people look back at and say, well, you shouldn't have been lowering rates because things got out of control. This is not the 70s, so it is different. There are some supply constraints that are issues. There's too many open jobs versus people that are taking those jobs. There's some things that are different. And in the 70s, the big problem was oil. I mean, basically it went in a 7-year period from $4 to $40 a barrel, right? That's an incredible move. And right now we're at around 70 something dollars a barrel. We're probably not going to go 10 times and go up to $700 a barrel. If we did, we would have similar inflation to what they had back then. So, but it's a different scenario for oil too, because the U.S. produces so much now.
Yeah.
We didn't used to. So this has some significance for the market because the market likes this if the rates are coming down, unless they're coming down because we're falling apart.
Yeah, if there's a recession, market does not like
That's right. So it kind of depends on the type of recession. I've seen some light recessions where, they declared a recession after it happened. You think, well, it didn't even know it, right? Mm-hmm. And those times, sometimes, they're lowering rates and the market's just moving along and doing okay. But obviously 2000, 2008, with those big, heavy recessions, you're going to get, some issues with that. So, anyway, this also has significance for those people that are doing CDs right now. We've got a lot of people doing CDs. And so maybe a little bit longer term CDs or longer term treasury bonds. If rates are going to come down, you might want to lock in some of these rates, on a ladder or what have you. So I think that's important to understand. Okay, so last piece here. This is just kind of fascinating. Again, this comes from Bloomberg. It is basically a combination of what is expected coming out of the Federal Open Market Committee, the Fed. So the black lines in here.
Actually, this is just an economist.
Right. Yeah.
Their project.
Got it. And the black is this year, 2023. So if we just kind of go down, the Fed funds rate, the GDP growth. So that's how much the economy is growing, right? Unemployment, PCE. This again. They're not using CPI. Finally, the press is catching on that PCE is the measure of inflation that the Fed is really looking at the most. And then core PCE is the piece that they're looking at even more than just overall PCE, which is where they take out food and energy. So if we look at that, if we look at the Fed funds rate, the pink-ish is next year, blue is 2025, green, yellow is longer term, and then long run, longer than that. So you can see they're expecting the Fed funds rate here all across to come down, right? Next year, the year after, long term and long run, all coming down, right? So that means rates coming down fits in with that dot plot. Yeah. GDP growth better this year than they're expecting on these other years. Next year, that should get soft.
Yeah, there's a slowing of the economy.
Right. Now, technically, a recession is 2 quarters of negative GDP. This is still showing a 1-year positive. So you can still get 2 quarters to squeeze in there out of 4, but not expecting probably, in my opinion, on this chart, a recession next year. But we'll see how that works out. And then things kind of picking up to more of a norm in 25 and beyond. unemployment rate goes up some, right? Next year, the year after, that's not going to be a surprise at all with the amount of rate increases that they've done. The Fed has projected that we would move to 4.1% quite some time ago. We got up to 3.9 and then dropped back down to 3.7. So still very good market. Still full employment is considered 4%. So, and then inflation, PCE, and core both falling, right? That's the projection. So all of those things are really good for the stock market, assuming that whatever slowdown we have is more of the soft landing, or not such a hard landing. And so that's going to be. I've been saying this all the last couple of weeks here. I think we're shifting the conversation from inflation to recession, and that's going to be what we're hearing about, because you can see the data comes out. And you can look at it either way. So we get lots of jobs. Oh, the market drops, because that's an inflationary look. And when you're thinking about recession, lots of jobs, market will go up, because that's going to help us to get out of recession. And jobs aren't a great example because it's a lagging indicator, but nonetheless, that's what we're looking at. So altogether, really good time frame. To be in the market. The year turned out to be fantastic. Still, making back what we lost, unfortunately. Even this run up we just had, we're still, just barely getting above where we were back in July. However, that's what you want. You want, some direction. And the market is, roughly where it was almost 2 years ago. Companies are making more money, right? The growth rate slowed down some, but it's still positive. And so if you look at the S&P 500, so they've made more money. The earnings are higher, even though the price hasn't moved in 2 years.
Yeah, so it's kind of like the thought that it was overpriced in 2022. Yes. Now it's kind of the earnings have caught up, and now the price is kind of according.
Yeah, it's still overpriced on a very historical basis, no doubt, but not nearly where it was, before this started, right? So what happens is that this is the way the market kind of lets off that steam and lets things get back to, some reasonable level. And the market is a representation of human emotion. So we almost never at a reasonable level. We're either, a mania on one side or, total, panic on the other is kind of not unusual. And so you just have to kind of understand that and be able to ride through some of those things. And, when things are really flying, have a more moderate outlook on that, and when things are really falling apart, have a more moderate outlook on that also. There are certain places where you got to be careful. We don't want to ride through the next Great Depression, but generally speaking, this year, none of that was happening. We had a 10% downturn, as you mentioned. That's not that uncommon. So that's what we've had for this week. Really enjoy everybody watching these summaries. And again, we'll be doing this again at the beginning of the year, January 5th or 6th or whatever the next Friday is after the New Year's, and we'll talk about that then. So thank you for watching all of these.